Welcome to Market View with Ike Ios and friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Well, gentlemen, good morning. I'm Ike Ios, your host for Market News. Today's guest, my good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, Ike. How are you?
I'm doing well, and I'm looking forward to speak with you today because over the last couple of days, we have had a pretty strong rally of the 200-day moving average and also declining top line, which was resistance, and now it has become support. So I'm curious to hear your thoughts, whether the rally has legs or not. What do you think?
I would think so, for one reason. Yesterday, Thursday, the market had every excuse to go down, and I mean go down hard, because yields across the curve, 2 to 5 to 10s, were really pushing higher. And, at the same time, you had the S&P 500 and the NASDAQ and the Qs basically below. I think 2 out of those 3 were actually below the 200-day, not by a lot, but, in a precarious position. And, all of a sudden, we rebounded strong, the rest of the day, kind of did another kick save, if you will, and we've had this second follow-through day. So if we go to the first chart, there's some positives and negatives here. We are making another higher low, which would be the second higher low. We did have a failed breakout, which sometimes can be very bearish. We're pushing up against the trend line. We're actually above it here later in the day off the October lows. That was a negative. We got to get back above there. And we had the 513 EMA crossover back in around March 17th, 21st. But as you see, the blue dotted line, which is the 5 EMA, is curling up rather quickly. And it probably would take only a day or two of more gains to move that simple moving average crossover back to on a buy signal. We go to the second chart, also a S&P 500 daily chart. If we look very closely at the data from this past week, we actually tested the 200-day, which is the green line, on 3 days. And as I said, we were just slightly below it yesterday. At the same time, although not perfect, we were also back testing the bear market trend line. Many times when an index or a stock breaks out above a trend line, lateral resistance, it'll come back, what's called a back test, and then take off, and that's exactly what we did. So far, the bullish outlook here is still intact, although, the market was a bit wobbly here and a lot of nail biting by us bulls, but so far so good. Go to the third chart, is a weekly chart of the S&P 500 showing that we retraced 50% of the bull market off the pandemic lows. In October, we've taken out the purple bear market trend line. You can really see over the last 2 weeks we tested that almost to the penny. But I wanted to show on here, if the market rolls over, there's a couple levels of really strong moving average support. We have the 200-week moving average, which is the green line, and that comes in around 37.21. And then we have the 50-month exponential moving average near 3,700. Both these averages have acted as support for most of this bear market. I think the weekly was undercut. Yes, the weekly was undercut during the pandemic, but only by a couple weeks. So these are really important long-term bull market supports in case we do roll over again. We don't have to go all the way back to the October lows. We do have nice support here from these long-term moving averages. If we continue higher, which I think we will, I think we'll get up to this 4,300 area, which is the next key on the upside. That was the highs from back in August, mid-August, and it also represents a 61.8% retracement of the entire bear market. So that's a that would be a key area, kind of a magnet area. I think if we get there, we would probably pause, maybe pull back, and then we'll go from there. Looking at chart number 4, this is just a daily of the NASDAQ composite. The green dotted line is the bear market trend line, and then the dark green line is the 200-day. And you see the NASDAQ also fell below the 200-day yesterday, but held, and we're back above the 21 EMA today. A lot of resistance here on the NASDAQ. I put in some Fibonacci retracement levels, and like the S&P, I think the key one here will be from the August highs, which also represents a 50% retracement of the bear market, and that's around 13,100. And if we go to the next chart, the daily chart of the triple Qs, basically the same thing. Triple Qs actually retraced 38.2% on this January, early February rally. That's where we stopped. Pulled back almost right to the 200-day, very, very close there, and have popped like everything else. So it looked like, for all these indices, it looked like we had false breakouts, breaking over the November and December highs, but you can see here the triple Qs are back above that level. So I think that's, rather positive here, especially in light of some of the recent move in yields and all the bearish talk from the Fed, hawkish talk. If we go to chart number 6, this is the breadth chart that I like to show. The top panel, solid red line, shows that we have 65% of stocks on the S&P 500 above their 200-day or longer-term moving average. This is, we're in bull market territory. I'd like to see us get back up above 70-75% and stay there. That would be more confirmation, I think, that the bear has been put to rest. But so far, so good as far as the percentage of stocks above their 200-day. And chart number 7 is a sentiment chart. This is the name exposure index. Early February, we got up to 85%, which isn't, it's somewhat bullish territory or when you look at exposure, but certainly not as high as it's gotten, during a bull market or an extended bull market. But you can see it only took a couple weeks weakness, and which represented about only 5.5% decline on the S&P to bring this back down to about a neutral reading around 47%. And I think when you see sentiment turn tail so quickly on such a minor decline, I think that's bullish. I think people got on the wrong side here. Sentiment got too bullish too quickly, and we had this minor pullback, and everybody seemed like that, a lot of people threw in the towel, and it says to me that a lot of people aren't convinced that the low is in. So I think that's a good sign from a sentiment standpoint. We go to chart number 8. We have the 2-year, the 10-year, and the 5-year. This is the reason the market pulled back. These yields bottomed in early February and really took off. Today, we are seeing some relief. The 10-year got above 4%, so it's back below 4%. The 2-year yield has backed off just a couple basis points today, and the 5-year has backed off a little. Probably will need some continued help, lower yields, that is, for the stock market to continue higher. What's interesting with the 2-year generally leads Fed funds, and for a while there, it looked like it was, as it was declining. But with this latest push higher, where basically the market is following the Fed funds or the government rate, which is somewhat unusual. It's usually the opposite. Usually the market yields lead the Fed funds rate. Sticking with bonds on the chart number 9, this is TLT iShares 20-plus year Treasury bond ETF. We broke the downtrend that started back in December, and we rallied, a decent rally, and we stalled, and now we're in sideways consolidation. We did drop on Thursday right to the prior lows from early January. So I think, for the stock market, set to continue higher. I think we're going to have to get some cooperation from the bond market, and I'd like to see TLT break out of this range to the upside. I think that would really help a lot.
Mark, anything else you would like to add?
Yeah, I don't usually look at really, really, really long-term charts in these videos, nor do I look or talk about them in my newsletter. But when natural gas prices started to plummet, as they always do after spike higher, I checked to see the long-term chart going back to 1990, natural gas futures. I wanted to see where they typically bottomed. And if you look at the green boxes I have going back to 1998, there's 6 boxes here. All the time, the natural gas futures either bottomed around $1.50 or $2. One time it was a little higher here back in 2009. So that interests me a lot. And then I looked like there was some kind of cycle low period if you just eye up the chart without the vertical lines and horizontal lines. So the green vertical lines here are cycle lines, and they're spread out every 3.5 years. And it's amazing, if you look at 1992, 1995, 1999, 2002, and then jump to 2009, 2012, 2016, and then 2020, those green lines pretty much, not perfect, but pretty much match up with these ultimate natural gas lows. So the next 3.5-year cycle here comes in about mid-2023. I mean, we could have hit the cycle low already as we got down to, I believe we hit about $2.06 about a week or two ago on natural gas. And at the same time, we have pretty good COT data, and we also have, obviously, bearish sentiment. So this natural gas chart kind of reminds me of a VIX chart. Natural gas obviously can't go to zero. VIX is never going to go to zero, I wouldn't think. And you have these, spikes every couple of years. So when natural gas gets killed, you can take a position, and if it goes lower, you just keep, adding to your position, average down. Eventually, based on history, gas prices are going to go back up. So I thought this was a very interesting long-term monthly chart to look at.
Mark, thank you. Have a great weekend.
You too, Ike. Thanks for having me.